This video explains consulting and advisory fees, their structure, and payment options, and highlights ERISA's strict disclosure requirements under Section 408B2 and 404A5. It underscores the importance of transparent fee reporting to ensure participants and plan sponsors understand all costs. Another ingredient in fees are consulting and advisory fees. These can be a flat dollar expense or they can be an asset-based. They can be paid by the plan, they can be paid by the company, they can be paid by the participants. It depends on how you slice the costs up. Often they're paid out of plan assets, and they can sometimes be paid from 12B1 fees if they are already available within the investments that you are utilizing. Consulting and advisory fees can be part or all of asset-based or embedded into the investment management expense. They can also be paid out of an ERISA budget if the plan is eligible and is established in ERISA budget. Fee disclosure requirements include ERISA Section 408B2, which requires covered service providers to disclose in detail aspects of their fees in writing to the plan. They must disclose it before there's an agreement entered into, before a contract is signed, and annually thereafter. This disclosure must include a description of the services provided, all of the services with a description of both direct and indirect compensation. Direct and indirect compensation includes anything of monetary value. The disclosure must contain sufficient information to permit an evaluation of the reasonableness of these fees. The DOL knows that record keepers are famous for obscuring the fees of the plan to make them seem less than they perhaps are. So that's why this reporting requirement is so specific and so detailed. If a service provider is receiving indirect compensation, it must disclose from whom such indirect compensation is received, so that indirect compensation is not received directly from the plan. With respect to the investments, the fee disclosure must describe the compensation charged directly against the amount invested, and that is the wrap fee. That reduces the expenses of the plan and the annual operating expenses. The expense ratios for operations and any ongoing expenses in addition to annual operating expenses, for example, wrap fees, mortality expense. The reason they're covering all the bases here is because, again, they know that service providers, particularly the record keepers, are experts in, again, obscuring fees and saying, well, we don't have an expense, we have a fee. We don't have that fee, but we have, and they won't say it, but we call it an expense. So the DOL is using any verbiage that can possibly relate to the plan fees and plan expenses to get the point across here. There's a corollary to the employer fee reporting, and it is participant fee reporting, which is intended to be just as if not more explicit and detailed than the employer reporting, and that is the ERISA Section 404A5. These fee disclosures must include, number one, an explanation of administrative fees, two, fees actually charged against the participant accounts, three, individual expenses deducted from the participant account, such as service fees, loans, quadros, etc. And four, investment fee and expense information, including the amount or description of fees charged directly against participant accounts, as well as total operating expenses expressed as a percentage of assets, which is the expense ratio. And here's the additional item, a dollar amount of each $1,000 invested. They must make their fees explicitly clear. Finally, any additional ongoing fees to the extent not included in these other expense definitions. So you know, we don't care what you call it. It's what the EBSA and the DOL are saying. We want to see every dime that can be possibly paid by the participant. This is typically a quarterly report, and most record keepers are set up to do this quarterly and TPAs as well, but it does not have to be quarterly if there have been no changes from the previous quarter. So a couple things from an action step. One is to establish and follow prudent process to understand, monitor, and document the fees. Accept only full and transparent disclosures. Regularly benchmark the fees, services, and investments. And just be aware of some opportunities to potentially renegotiate or investigate potentially lower plan or investment costs.